How do you calculate the lot size that you need on every trade so that you can control your risk and your emotions? Let's talk about that and more right now. Hey Forex traders, Andrew Mitchem here at the Forex Trading Coach with video and podcast number 374. So I thought I'd come outside today. It's a lovely winter's day here in Nelson. Lots of good feedback on last week's video when I took on a helicopter trip. So glad that you enjoyed that. And I figured, well, it's so good, let's get outside again today and explain a very important topic regarding what makes the difference between potentially a losing Forex trader and a successful Forex trader. And it comes down to money management and risk and understanding how to calculate the lot size that you need. You see, the problem is that most people, when they trade, is they will put on 0.1 lots or 1.0 lots, something like that. And look, I did exactly the same 16 plus years ago when I started trading, because that's what you think you should do. And when you see people showing trades online, they'll put something like, you get paid $10 per pip, and if you make 100 pips, that equals $1,000. The problem is that's not quite right, and it's quite a bad way of trading. And let me explain why. Because in order to trade with low risk and controlled risk, what you need to do is actually calculate the lot size that you need on every trade that's specific to that trade. You can't just go and say, well, I'm going to put on 0.1 lots on every trade. It's not a good way of trading, because you're going to find that you have different risk on each trade. You see, different currency pairs pay a different amount per pip, depending on what currency pair you're trading. But not only that, also depends on what the account you're trading is based in. So, for example, it may be in US dollars, it might be in New Zealand dollars, it may be in British pounds. So you can't just say that every trade is $10 per pip or $1 a pip, because that's assuming that you're trading something like the euro US dollar or the pound US dollar, and your account is in US dollars. So if it's not in US dollars, then the $10 per pip logic doesn't even make sense anyway. It's inaccurate. And so that becomes the issue. It's so easy to look online and people showing you trades that they make, and like I said, 100 pips equals $1,000. No, it's not true. So you have to be quite careful there. So what you need to do is actually place the stop loss on the trade at the level it needs to be at. Don't just go and say, I'm going to put a 20 pip stop loss in, because 20 pips doesn't mean anything. You have to put that level at the price level where it needs to be for that specific trade. And then what you do is you then work out the dollars per pip or the pounds per pip of the currency that you're trading, and according to your account denomination. And then you work out the lot size needed for that trade. And so that all starts to sound a bit complicated, doesn't it? And the great thing about it is I have a lot size calculator freely available on my website, and I'll put a link next to this video and podcast, that works on any MT4 or MT5 account. And all you simply do is drag it onto the screen. It's called a script. It's not an indicator, so don't go putting it on the indicators folder. It won't work. It's a script. Drag it onto your charts, and it knows what your account denomination is, and it knows what chart you're putting it onto. You drag it across onto your charts, and you put in your risk level, let's say 0.5% or 1%, whatever it is you want to risk, and put in the stop loss of that trade. It tells you the exact lot size. Now, what that also does is it gets you away from thinking, I cannot trade something like a daily chart because the stop loss is too big and my account size is not big enough. It gets you away from that mentality, because every single trade that you take by using this calculator gives you an equal risk on your account. Doesn't matter what the currency pair is, what the time frame is, or what the stop loss of that trade is or needs to be. It doesn't matter. It will calculate to say, if this trade goes wrong and you get stopped out on this pair with X number of pips as a stop loss, you will lose your predetermined risk. In my case, 0.5%. So that enables you to do quite few clever things. So for me personally, I like to trade at 0.5% risk per trade. But if I'm sometimes seeing reversal trades, I might actually reduce that to 1/4%. If I'm seeing continuation trades where I'm trading with the trend, I might keep that at 0.5%. So you can do all those kind of really, sort of fine tuning your trading really well. And so that's how you work out the lot size you need per trade. It really helps to control your emotions. It allows you to trade a variety of time frame charts. And this week's a prime example. We took 3 trades on the weekly charts for our members that we posted on the membership site on Monday. 3 fantastic trades on the weekly charts. It's been quite a choppy week this week. You know, some of the other time frames have not been particularly easy to trade. They've not had very many setups. So, for example, trading the weekly charts, I still have controlled risk, and even though my stop loss is bigger, my position size is smaller. But my risk if the trade goes wrong is identical to if I was trading, let's say, a 4-hour chart. So don't think that you can't trade a weekly chart because you might need a bigger stop loss. By understanding risk and understanding position size, like I've just taught you, and using my calculator, it allows you to trade all time frame charts, all pairs, regardless of the stop loss needed for that trade. So I hope that helps. I hope that helps you understand risk. It helps control your head. It helps control your heart. In other words, your emotions. And that is a massive part of trading. If you don't believe it is, you're probably on a demo or a very small live account. Once you start going to live accounts with bigger sizes, I can promise you that your emotions and understanding how they affect your trading is another big part of trading. So in other words, keeping risk low and controlled. If you can do that on a small account, when you go to a bigger account, you can do exactly the same because your risk as a percentage is identical. Therefore, your emotions are in check and controlled. I hope that helps. It's a big part of trading. Get that right and you're on the path to success. Like I said, the lot size calculator is available on this site. There'll be a link on here. It works on any MT4, any MT5 account. It's free of charge. Use it. It's fantastic. It will massively help your trading. So once again, this is Andrew Mitchem at the Forex Trading Coach. You have a fantastic day or night, depending on when you're watching this video. I'm off to enjoy this beautiful scenery. Have a great day. Bye for now.